Hey guys, what's up? I'm Erin and welcome back to the channel. The past few weeks, they have been rough. The market has taken a serious hit, and if you're like most investors, especially those at or near retirement, you might be feeling a little nervous right now. And I get it. When you're depending on your portfolio to generate income with these wide, volatile swings, they can shake your confidence and it can make you start to question your financial security. And more, I'm hearing, should I even be invested in the market right now? So today, let's take a step back, let's take a deep breath, and let's look at what's actually happening, and more importantly, how it actually affects you. I'm going to make a quick note before we dive into this video. This video was filmed on April 8th. The very next day, April 9th, the market had a massive rally. The Dow surged nearly 3,000 points, the S&P 500 jumped about 9.5%, the NASDAQ soared over 12%, largely in response to a pause on reciprocal tariffs announced by President Trump. And then on April 10th, the market took some of those gains back. Moral of the story is the numbers seen here might be a bit dated because of the volatility that we're seeing in the market, but I still believe that the message of this video, that the performance of your portfolio relative to the performance of the overall market is very important, especially for those who are retirement-focused investors. Let's start with the numbers because they're getting headlines for a reason. The S&P is down over 15% year to date. The NASDAQ down almost 21%. And the Dow Jones, it's down over 11% year to date. As of this filming, those numbers are subject to change. These are very dramatic drops in a very short period of time. So it's no surprise that many investors, and especially those at or near retirement, are a little bit nervous. But the thing to focus on is that these indices don't actually or usually tell the full story. They're not designed to represent a balanced retirement portfolio. They're not designed to represent your specific goals or your portfolio. To help illustrate this better, let's talk about target date funds for a moment. Now, a quick disclaimer. I am not saying that target date funds are perfect, and I am not saying that everyone should be investing in them. What you need is a portfolio that is tailored to your specific circumstances and tailored to your unique risk tolerance. But what I do think target date funds are helpful for is visualizing how portfolios tend to change over time. So for this video, we're going to look at 4 Vanguard target date funds that span across different life stages. Let's start with the Vanguard Target Retirement Fund 2070. This is for someone just starting out in the workforce. Retirement at this point is decades away, so this portfolio is understandably aggressive. About 90% of it is in equities, both US and international, and about 10% is in bonds or cash-like equivalents. Then we have the Vanguard Target Retirement 2050 Fund. This fund is for someone who's mid-career. Maybe they're 25 years or so from retirement. Again, it's still very aggressive, 90% in stocks and 10% in bonds or cash-like equivalents. Then let's move to the Vanguard Target Retirement 2025. This is for someone who's on the brink of retirement. Now we're looking at a more balanced allocation at this point. About 50% is in stocks and about 50% is in bonds or cash-like equivalents. This still allows for some growth to keep up with inflation and maintain purchasing power, but it's also prioritizing more stability and income generation. And finally, we'll look at the Vanguard Target Retirement of 2020. This one is for those who are already retired. At this point, we only have about 37% in equities and about 63% in bonds or cash equivalents. It's a much more conservative portfolio because the goal here has shifted from wealth creation to wealth preservation. Now let's take a look at how these target date funds have performed this year. The 2070 fund, it's down a little bit over 9%. Same with the 2050 fund, it's down a little bit over 9%. Once we move to the 2025 fund, it's only down a little bit over 4%. And the 2020 fund, it's down about 2.4%. Now pause for a second and let that sink in. And let's take a moment to compare that to the broader indices. The S&P 500, it's down over 15%. The NASDAQ, about 21%. And the Dow, about 11%. When we compare the performance of a more balanced portfolio to these broader market indices, we see something very important. They have fared significantly better. And that's exactly the point. If you're in your 20s, 30s, or 40s, and you're invested in something like the 2050 or the 2070 fund, yes, you have taken a hit. Your timeline is decades long. You don't need this money right now. Yes, you're in a more aggressive allocation, but you can handle this volatility because you have time on your side. But now let's shift our focus back to those at or near retirement, because this is where anxiety tends to peak when we see these big market swings. If you're in a 2025 fund or the 2020 fund, or maybe you have built your own portfolio that has a similar type allocation, you're seeing far less losses or a far smaller drop. We're seeing losses in the ballpark of 2 or 4%. And it's not to say that these declines are insignificant, but they're not catastrophic. They're not going to derail your retirement plans. They're not going to derail your withdrawal strategy or leave you without an income in retirement. This is the value of having a portfolio that matches your risk tolerance and your life stage. And this is exactly why I always recommend going into retirement with a solid cash buffer. Whether that is 2, 3, 4, or even 5 years of expenses in cash or cash-like equivalents, this gives you options, this gives you confidence, and more importantly, it buys you time. Because the last thing you want to do when the markets swing like this is be forced to sell your equities at a loss just to make your withdrawals. But if you have a built-in cash buffer, you don't have to. You can simply take your withdrawal from your cash account and leave your equities completely untouched and give them the time they need to fully recover. This move alone can go a long way to making a portfolio really last throughout the course of your entire retirement. Now you might be wondering, how long does it typically take for the market to recover from a downturn? On average, bear markets recover in about 2 years. The worst bear markets typically recover within 5 years. Some bounce back quicker, others take longer, but historically speaking, the markets have always recovered over time. That's why having 2 to 5 years worth of a cash buffer set aside as you go into retirement is such a powerful strategy. It's not just about protecting your portfolio, it's also about protecting your peace of mind. Now, I know the headlines are still scary. Just this morning, I saw one warning that the S&P and the NASDAQ are on the verge of a death cross. Now, let's be real. Headlines like that are intentionally written to provoke fear in the reader. But let's take a moment and talk about what a death cross even is. It's when the short-term moving average of the market, typically about 50 days, moves below the long-term moving average, typically about 200 days. It's a technical indicator that some people believe indicates that we're headed for deeper market declines. But let's be clear. It is not a predictor. It is not a crystal ball. There have been plenty of times where the death cross has happened and the market recovered. There have also been times where the death cross has happened and the markets did head for deeper declines. It is a lagging indicator. It is not a predictor of the future. The moral of the story is don't let this flashy terminology shake your financial strategy. Yes, the market is volatile right now. Yes, the headlines are loud, but that doesn't mean you have to panic. If you've built a portfolio that fits your life stage and your risk tolerance, yes, market swings like this might feel uncomfortable, but they shouldn't wreck your financial plan. And if you're feeling uneasy right now, that doesn't mean leave the market. Maybe it means reassess your allocation to better fit your risk tolerance. Investing isn't about reacting to the market. It's about having a financial plan that is strong, intentional, and resilient. You can't control what the market does, but you can control how you invest. How are you feeling about what's happening in the market right now? Leave your thoughts and comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. I just filmed 2 full videos without the microphone being plugged in. I want to just die right now. I was so happy to be done. I was like, yes! And then I looked and I was like, hate myself. All right, positive attitude. Let's do this. Second time should be better. I want to cry right now. How do I turn off? I cannot work this system. It is there is a thermostat that is far too technologically advanced for me, and I cannot work it, and I'm dying. I'm sorry. I'm having a meltdown. Erin gets frustrated. That's the title of this video. Sorry.